It is 4 o'clock. So we'll get the ball rolling on this end. So first off, everyone, thank you for attending. We're going to be going through our fourth quarter economic and market update. This is going to be the first one that we'll be doing. So just feel free to give me some slack. So there'll probably be a little bit of some, I don't want to say technical difficulties, but just new ways of, there'll probably be some opportunity areas to share this information a little bit more efficiently and such. However, you can't really know what to do better if you don't take a first chance start, right? So the goal is just to knock it out of the park.
And I just want to say, Karmi, I love that you jumped on the idea of doing these updates. I think it's huge value for our members. And I want to say hi to everybody. Welcome to our first inaugural one. It's good to see some of your faces. And I know Karmi's going to deliver some really good info. He's gone over some of it with me, but he's also got some surprise tidbits. So I'm going to let him take it away. But good to see everybody. Wanted to say hi.
Thanks, Francisco. So just like I mentioned, everyone right now is on mute. However, that doesn't mean we won't have time to ask questions. The goal is to try and get through, there's a lot, but the goal is to try and do it within 30, 40 minutes and then leave the remaining time for questions so that everyone can get their questions answered and such and kind of go from there. But just a couple things just to be aware of. If you, as we're going through the information and you want to ask a question and you don't want to forget, at the bottom of the screen where there's like a leave call, a little big red button, if you hover all the way towards the right hand side there, it looks like a little text box. If you click on the text box, there'll be a capability to send a message. So feel free to ask if you want a question to be saved for a later time, feel free to type your questions in there. I did send a chest chat, so I'm hoping you guys will see that. And it is turned on, so you guys should be able to send messages as questions arise, okay? So with that, let's kick this off. So the goal of these is, like I said, to keep you guys up to date what's going on in the market, what's going on in the US economy, as well as the global market. We're going to be doing these on a quarterly basis. So my goal is that at the end of each quarter, around the second week or so, we'll have a Q1, Q2, etc. update. I do realize that that's going to be around April 15th tax season, so we'll kind of pivot around that being the one exception. But the goal is to do these around the second week of at the end of each quarter. So with that, let's go into it. Overall, we had a really good year, right? When we look across the board from US stocks to international, to even on the safe money, on the bond side, it's been a really good year. And there have been a lot of driving factors associated with that. One is the fact that the US economy has been significantly more resilient than analysts as well as Wall Street has expected. That has been really in response to the US labor market holding up for the most part. We'll talk about some of the headlines that you may or may not have heard on the news. Consumers have been spending really well. If there was ever a way for America to get out of the problem, it's going to be on the back of US consumers. We'll just spend our way out of it. And that has so far been the narrative so far. On the international side, it's a little bit more unique. The reason why they've significantly outperformed the US this year is really in response to the fact that when the US exited COVID, they did it the COVID era. We were able to reopen a lot more quickly compared to Europe and outside the US, mainly because of the fact that they had much more strict COVID procedures. And while we were going through our reopening phases, Europe, Asia, Middle East, the emerging markets were just doing it a little bit differently. They were not as lax with that. Now, on the bond side, really the main driver for the returns has really been consisted of interest rates coming down, right? At the time of when, at the beginning of this year, there was a cut or so. Now there's been a couple more cuts throughout the year, and really bonds have been rallying on that news with the hope that the bond market will continue to get some gains in the next year in response to future cuts. I don't want to spoil the fun, but the consensus of our firm is we don't think those are going to happen, and we'll explain why as we go through the presentation. So overall, a really, really great year for the market. Will this happen again? The likelihood is not so much, mainly because of the fact that a lot of the catalysts that we talked about, it's very unlikely they'll continue into the new year, or at least at this level, which is the key point to kind of highlight. I did forget to mention, just as one quick compliance tab point, this video is being recorded as well as being monitored by Hazel, our AI note taker. So just something to be aware of, that that's what that Hazel is. It's just taking notes so that when at the end of this, after we get a review from compliance, it will be for you guys to review. But like I said, overall markets have done well. So I kind of alluded to what has been the drivers of the US economy, so I'd rather just give you guys some data. The reason for that is it really has been on the back of US consumers spending really, really well. When we look at this chart, what this is in English, it's showing us what the economic activity has been in the US from 2010 till 2025. What real means, it's inflation adjusted. That's the fancy word for it. And that GDP is gross domestic product. So that's the value of all of the services and activities that are being done in the US. And as long as that is positive, that is where you should see some strength in the overall economy / market. So a great example, as you see on the chart, there was a big dip 2010, right? That's right after the Great Recession. 2008, 2009, 2020 was COVID, right? That's when everything got locked up. The big skyrocket up from 2020, that's when markets started to open up again, right? So where we are right now is we are right on the average expected growth rate for the US, which is around 2 to 3%. Again, after inflation, that's really, really solid. So as long as this continues to hold, which we believe it should, which will go into the other sides, there is enough backbone for returns to stay competitive. Now, I'm being very selective with my words because competitive to what many of us are used to from 2023, 2024, and earlier over the past 10 years, right? A lot of us have been really accustomed to 10+% returns a year. That is not the likelihood going forward. It will most likely be in the range to 4 to 6 per year over the next 10 years. Now, these are just analyst estimates. You and I both know analysts get it wrong, and I hope they're wrong. But it is one of those things we just need to be prepared for, to at least set that expectation going forward. But overall, the US economy looks resilient. And really, the reason for that is we have a chart here for same store weekly sales. This is data from the a lot of the data we use is from the Macro Research Board. They're an independent data provider. Reason why we like them is how they make their money is not from selling data and then telling you buy my fund, kind of like a lot of what the other providers do. They utilize it from subscriptions, and the more people that subscribe because they're doing information correctly, the more money they make. That's what we want. We don't want any of the research that's usually has a ask that you buy their fund in return. So what I'm getting at here is the U.S. consumer remains strong, because when we look at 2025, we see that year-over-year sales are still around 5% growth. And that's what you see on the far right side. Yes, it has come down, and the reason for that is, you can probably guess it, is around April we had the fun announcement regarding tariffs. So that little drop has been in response to tariffs. But when we look at it historically, it's still really, really strong compared to previous years. So that, like I'll mention, you'll see a big spike in 2020, right? On both directions. That's when things closed down. And then when things opened up, Americans couldn't spend fast enough, right? So obviously there's going to be a decline. But what we like to see is, as long as this stays above zero, or at least within the normal averages of around 2.5% year-over-year growth, that's a good sign for consumers. One thing, I did not have a chart here, but I thought it was really important to highlight. Black Friday and Cyber Monday sales crushed it year-over-year. I have a specific note on it. I thought it was really important to highlight, but long story short, it was around 7 to 9% year-over-year growth compared to last year. It totaled around like $42 billion in a weekend. It's a lot of money. What that really shows us is that despite concerns with tariffs, despite inflation, U.S. consumers are continuing to spend. And that's what we want to see, because as consumers spend, that means that gives strength for U.S. corporations from an earnings perspective. So as long as the consumer remains strong, good signs, there are going to be good roads ahead for returns. I also wanted to include a chart. Americans are just overall wealthy. I know it's a little hard to see, so I'm going to try and zoom in. What we have here is essentially, hold up, oops, so we can see that. Be a little bit better. There we go. What you see is essentially the average U.S. household has experienced a tremendous growth of wealth across a lot of different benchmarks. When we look at it from a net worth perspective, when we look at it from a household assets perspective, no matter how you look at it, U.S. Americans have been able to essentially just experience a lot of wealth gain from 2005 until now. Okay. Now, this is also one of those things to just be aware of, is the fact that as assets grow and people have more money to spend, it can cause price inflation, which is something that we're going to see later on in the slide. But overall, we've been able to really spend more because we're significantly more wealthier than we have been in the past, which is a good sign, right? Now, we're going to kind of switch gears into the labor market. We have a strong consumer, right? We have a resilient labor market. And when we combine those two together, that's really why the U.S. economy has been so resilient up to this point in time. I wanted to tackle unemployment first because this is one of those headlines that always gets thrown around, but it's important to put it into perspective. So yes, unemployment is up recently, right? The most recent estimate is around 4.5%, but when you look at it historically, it's within normal realms. Now I know it can be a little what's the word? It's never fun to say normal realms when there are Americans that are unemployed. But when we're looking at it from a statistic perspective, it's not anything to be concerned about because it is fortunately, unfortunately, however you want to view the coin, it's within normal realms. So yes, it's up, but it's nowhere near COVID levels and nowhere near the Great Recession, which are those peaks that you see on the chart. Okay, so this is all from the Bureau of Labor Statistics. Now, it's also important to realize that for people that are flying for unemployment, you may hear the news always talking about these unemployment insurance claims, right? So when people lose their job, they need to go and get some unemployment help. There has been obviously upticks and downticks, right? A lot of that is been in response to certain companies that have overhired during COVID are now tightening the belt because they don't need that much capacity anymore. So yes, we have seen unemployment go up due to firings. However, it's isolated to companies that who have unfortunately overhired during COVID to meet demand. That demand is no longer there. So as a result, the corporations are tightening the belt. But as long as these weekly unemployment claims stay within normal levels, right, which is around that 220,000-ish in weekly claims, that's usually a good sign that the labor market is still going to remain resilient. Where we start getting nervous is if we see those peaks that you see in 2008 from the Great Recession and then COVID and from 2020 to 2022, right? If we see a large spike, then we can start making a case that the labor market may be unraveling. The best way to explain it in this situation is that we are slowing down, but that does not mean we're down for the count, okay? So we're going to switch to earnings. So a lot of the reasons why the US stocks have done very well up to this point in time is really because of the fact that US corporations have been able to maximize shareholder wealth through the income that they've been able to generate over this period of time. So how we measure that is through return on equity. So in English, what essentially that is how efficient is are corporations able to turn cash flow into earnings for its shareholders. And what you can see is that earnings for US corporations are near all-time highs, which means that companies are being really efficient in generating earnings for US consumers. The only thing that is concerning with this, and which is something we're going to talk about later, is that when you're starting at a very high point, it makes it very difficult to beat that going forward, right? The statistics become less and less likely that they'll be able to continue to do that, right? If you're already starting at a high point, you need something even bigger and better to get you over that hump. Now, in response to that, because we have such high earnings, analysts on Wall Street across the board are forecasting that earnings will continue to remain strong. The only risk with that is the fact that if those earnings do not materialize, that's where we may have some weakness in the market. But for right now, it's really important to just reiterate earnings have been resilient. They continue to remain resilient, which should be a nice support for US stocks going forward. We'll kind of talk about international in a little bit, but it's really important to just really highlight that it's a combination of resilient labor markets, strong consumer, and then US companies that have been able to just return value back to shareholders through efficient uses of their cash flow that comes in that has supported the market up to this point and the US economy. It's a little bit more unique on the international side, but there are similar elements that we'll kind of talk about. So those are the three main tenets that have really resulted as to why we believe that there should be some strength going into 2026 with regards to the US. However, that doesn't mean that we're going to have a similar return year like we had now, or in 2024 or 2023. Just because statistically speaking, the likelihood of having it when we're already at a high point, it gets less and less and less. And then just as a quick reminder, as questions arise or as you think of them, there is a chat function. You can find it by hovering over from the right of the big red button where it says leave call. There'll be two people standing on the side. There'll be actually a chat with everyone, a little text box. Click on it. You'll be able to put questions in the chat and go from there if you have and submit it, and then I'll answer it at the end. But like I said, overall, that's why the U.S. economy and U.S. stock returns have done what it has done, is really for those three main factors. Now, we're going to go in to some of the concerns or yellow flags that we're seeing currently for 2026. So this is where we start seeing where adjustments or the reasons why we're going to be making recommendations across the board is going to be coming from. And the first reason is really going to be because of how concentrated the U.S. economy is relative to history. So for those that are not familiar, the Nifty 50, that was essentially the most prestigious 50 companies at the time, selected by institutions back in the 80s. There were a couple companies that are in the top 10 this year that were there, like examples like Microsoft, etc. But essentially what happened, the Nifty 50 blew apart during the 80s when they had the market correction. And what this graph is showing us compared to history, the largest 10 companies, right? You can probably all name them: Apple, Nvidia, Microsoft, Google, Meta, Amazon, Tesla, JP Morgan, etc. They comprise almost over 40% of the U.S. economy, the U.S. stock market at this time. That is the highest it's been in history. That is one of those things that is a risk, because what happens is that of those 40%, right, of those 10 largest, 7 of those are AI related. So what that means is essentially that the market, as well as investors abroad, are making large bets on AI at this moment in time. And if those don't materialize, there could be some hurt along the way. Now, why am I concerned with that? Because we all have seen the returns that technology and AI stocks have done. It really comes down to the fact of how much they're actually spending to maintain the AI. So this is all, the data that we're seeing on this chart is all from their most recent quarterly filings. And what we find is is a little absurd, but the top 5 of the top 10, the most AI specific within the 10 largest firms in the US are outspending hand over fist one of the more heavily capital intensive firms, like oil and gas companies like Chevron and Exxon, and the auto space like GM and Ford, right? With Meta, they're essentially spending almost 30% of their quarterly budget to maintain AI in the data centers, with the next highest is Alphabet being around 22%. And then it's more or less in line with Microsoft and Amazon. But where the concern is that if we have 45% over 40% in the 10 largest companies, 7 out of the 10 are AI related, and on average they're spending over 20% of their budget just to maintain AI, it is a concern, because if those investments that they're making in AI and demand falls, we're going to see a world of hurt for these companies, and we're going to see some weakness in the US, right? I had a chart on this, I don't know if I included it, but it'll be there on Thursday. But essentially, one of the really important things that I was comparing this to is during the tech bubble, there was a lot of investment into the fiber optic cables. So in 1998 through 2000, fiber optic cables, the internet, all that was going to be the biggest thing since sliced bread. And it was. The only problem is everybody and their mother was creating these fiber optic networks and creating the infrastructure for that. So what happened is that there was so much oversupply that these companies that were creating those networks and the fiber optic cables, they had to compete on price to win business. So they spent all this money, but they weren't able to charge maximum value for that because there was so much competition. So the concern here is that with AI, if you don't continue to spend in the same clip, there is a risk of obsolescence, right? with the fiber optic cables, once you set the infrastructure, cables are cables, right? Yes, they could be better, but the need to constantly improve that becomes less and less, which is not the case with AI. So if you want to be the quote unquote leader in AI, you're going to have to spend big money. And the concern is that if they're going to continue to spend and then they're not going, and then the demand, or they're not able to get the pricing points to justify the costs that they're spending, it's going to be a world of hurt for those companies. So to put it into perspective, like ChatGPT, they just got financing. I think it was around 30 billion, and the revenue that they're generating from that is not even close to justify what's being spent on that, and that's a concern. Now, when we also look at the reason why I'm bringing this up is because a lot of demand for tech and AI has really been kind of fueled by these expectations that AI can only go up, because the utilization of that is unlimited, which is true, right? The only problem is that when you have investors pushing prices up, things get really, really expensive. So in the US, what you'll see on the top chart is that historically, the average stock has traded around 16 to 17 times what they bring in earnings. That's on average, and that's usually a healthy sign for the US stocks. What we're seeing is that we're trading at a level above 20 times earnings, closer to like 23, 24. Why that's concerning is that we have a lot of investors that are essentially making the bet, I will pay a higher price relative to what the companies are bringing in, historically speaking, because I believe they'll continue to go up, when that may not necessarily be the case, right? And the main driving factor of that, is that's what that bottom chart is kind of showing you, is that if we take out technology, it's the technology companies that are driving that overvaluation in the US, which makes sense, right? 40%, over 40% of the US market is in the top 10 names that we all know. 7 out of the 10 are tech related and AI related, so it makes sense, right? There are cheaper parts of the US market, which is encouraging, but it's important to really remember that even though the cheaper parts of the market, like energy, industrials, pharmaceuticals, the less sexier things, they're still trading above the average of 17. So the US overall has gotten very expensive, which is why it is our best thoughts to start looking into international, to see are there more into the international space, because are there opportunities there? And what we will find is that there are, and we'll kind of go through that together. But overall, the US has gotten expensive mainly because of technology and those technology names that everyone's kind of betting into and putting more capital into. Now, it's a little bit different across the pond, right? So these aren't the best charts I could find, but I wanted to just talk through it because I think it's important just to kind of explain it. So the chart, what that top chart is explaining is how much at a discount are non-US companies trading relative to the US. So what that minus 20 that you're seeing on the top chart is saying is that on average, non-US stocks are trading at a 20% discount compared to their US counterparts, which is a really, really, really enticing entry point, because if we are trying to find the most efficient way to invest your guys' money, we want to have the best statistical chance to be able to realize profits, right? And again, nothing is guaranteed, but we want to at least get a chance to be able to outperform. We want to go into areas that have a better probability of doing so by buying things that are lower priced compared to those that are higher priced, okay? We'll kind of talk about why Europe has been a lot cheaper, but I want to kind of hit home on these points first. The bottom chart is talking with regards to, it takes it one step further, and it shows what has been the overall price discount that non-US stocks have traded when we take into account all the volatility, inflation, and some of the geopolitical risk. So what it's really showing us is if we take into account inflation, other specific avenues that are captured when we calculate a cyclically adjusted price to earnings ratio. It's a mouthful, but think of it as a more true estimate of how companies are valued. It's even more enticing. It's actually trading at a 40% discount, right? We want to find areas of the market that have better opportunities to outperform, and we believe the best way to do that is moving into areas that are, we believe, underpriced, so that eventually, when markets catch up, when they see the earnings start to materialize, they start moving in that direction. That's why we have seen European stocks and emerging market stocks do so well this year, is because analysts were surprised at how those markets have done, right? When everyone and their mother is thinking, well, we shouldn't be in that area, we should only be in the US, right? And then there's surprises, that's how you get exciting returns. Now, the last thing that I really wanted to kind of talk about is inflation. I don't have good slides with regards to Europe on this, but I did want to mention a couple of things that are enticing outside the US. And it really is going to revolve the fact that the companies that we've already talked together, that the non-US world, right, and exited COVID much later than we did. And a lot of those corporations, as well as non-US consumers, have just now or this year started their spending, going on trips, buying the stuff that they want to buy. Just Europeans have been frugal in response to COVID. That's very different than us Americans. We like to spend no matter what. The Europeans and non-US individuals, it just took a little bit longer for them to start spending. And now they have started to feel a lot more comfortable spending across the board, which is why a lot of corporate earnings across the pond, right? Europe, Japan, Middle East, Africa, and South America, etc. We have started to see an uptick in what those companies have been able to generate from an earnings perspective, right? So if the consensus was that these markets would not do well, and then there are surprises, that's what leads to strength. So we are seeing a consistent trend of non-US consumers beginning to spend and continuing to spend, and those corporations being able to utilize that cash flow efficiently and return earnings back to shareholders. That's a good recipe for good returns, in theory. We'll move to inflation. So inflation is that word that everyone thought was going away, or the Federal Reserve wants you to believe is going away. It's not going away. They have just ignored it and are starting to focus on other more material news. And for them, that's focusing on the labor market. When in actuality, they should really be focusing on inflation. The core inflation metric that you see at this chart is taking into account price movements that do not include food and energy, which is really silly because if we don't live on a core world, we live in a high level world. We all need to eat, we all need to pay energy. So why are we including this chart? The problem is the Federal Reserve operates on a core mentality. Don't ask me why, that's what they do. So we have to play on the monopoly board given to us. So their goal is to try and get inflation to be at the long-term average of 2%. And for the most part, they've been pretty successful from 1995 up until COVID. And the reason why they weren't in COVID is at that time, Jerome Powell said inflation was transitory, and he was unfortunately wrong, and we had the spike, and then we had to hike interest rates, which is why you saw from around 2022, you see that drop back to more normal levels. The only problem is the argument that is being made right now is, as we have already experienced a large amount of deflation because of markets opening up, supply chains are opening up as well. They've already done so. The premise is that this will continue to happen even despite tariffs, is what the goal that the Federal Reserve is saying. We are not convinced. If anything, they're just not admitting that they're comfortable with inflation being above 2% or potentially above 3%, because that's where we're sitting at right now. And if consumers continue to spend and wages continue to grow and asset values continue to rise, right, that's only going to further fuel price increases across the board. Why would businesses, companies lower their prices if you and I are still going to buy the same products at the higher price? There's no incentive to drop prices, right? So as a result, we're just going to be at an artificially higher level. And as a result, this is something we need to plan for. Now, I also wanted to include other backup as to why I believe inflation is going to stay above 3%. And the reason for that is we have now started to see a large uptick in U.S. good prices starting to increase on a year-over-year basis, right? There was that initial drops, right, because the supply chains opening up post-COVID, that's why you see those drops. But you're seeing the large uptick, and you guys can all probably guess why. It's because of tariffs. And if tariffs will continue to remain, it will provide some inflationary risk across the board for you and I, because it's a tax on the U.S. consumer. That's what it is. Now, there are benefits to having tariffs, but it is something just to be aware that goods will cost more expensive if the shoes that you buy from Nike have to pay a fee to bring it in from abroad, right? So we're starting to see inflation start to impact goods when originally that wasn't the case. And it's really the main catalyst is tariffs. So that's going to be something we'll continue to look at. Now, the one point that's probably the most concerning is we're seeing services, right? So this is when you go and buy insurance, when you go and get your when you go and get a knee replacement, when you go do any type of medical service, going traveling through hotels and leisure, right? These are all services that have remained sticky because U.S. consumers have been overall earning more money over this period of time. The wage growth has been around 4% this year, right? Now, if wages can go up and consumers continue to spend, regardless of what the price is, there's no incentive for these companies to lower prices, right? So we're kind of in a catch-22. So the one thing that's concerning is that services, when we look at it to pre-COVID level, it's still higher, right? That's what that 2025 and that little blip is showing, right? When we compare that to 2020, right, we're still above what COVID was. And that's really in response to just wage growth and just how people's portfolios have grown, wages have grown, right? If there's more money to circulate chasing fewer goods, we're going to have inflation, right? Or if there's not enough people providing the services that we need, if people want to travel more, or they can't get a hotel, or if they don't have enough doctors to go and schedule those medical procedures, right? What are they going to do to incentivize to get the most bang for their buck? For people who are willing to spend, they're going to raise prices. So it's very unlikely that services will come down because there isn't any incentive to do so for these companies, because we'll just continue to pay it. I'm not trying to be a Debbie Downer with all this information that we're sharing, but the goal is to give you guys informed information so that we can be proactive instead of reactive if some of these events materialize, right? We hope we're dead wrong, and the market just continues to do what it's been doing. But from a statistics standpoint, it may not be the case. So what are we going to be asking for everyone to consider? Because at the end of the day, this is your guys' money, and everyone's specific situation will be different because your needs and goals are different. So the four main categories that we're going to essentially be having people consider is really doing the following. One, for those that it's suitable, right, we want to start making moves into more international stocks, right? Moving from the US gradually and moving international. When I'm saying gradually, right, through our conversations, just so everyone remembers, if the market is 60% US, 40% international, we're talking about going 42% international. We're not betting the farm. We're just tilting into areas where we believe long-term expected returns can come from. We're going to want to, for those that it's suitable, right, we're going to want to focus on dividend-paying companies in accounts that you may be considering or are currently withdrawing funds from. The reason for that is we want to, one, reduce overall volatility in your guys' portfolios, or at least give us the capability or the chance to do so, right? While at the same time diversifying away from the tech heavier parts of the market, right? So what may be recommended once we talk, depending on the situation, leaving your Roth or your most tax efficient accounts to remain aggressive, and provide and allow your least tax efficient accounts, your IRAs, maybe certain taxable accounts, depending on the situation, to be more conservative by being in more dividend focused companies in order to be so that we can play offense and defense at the same time. Probably the one that will be the most unanimous across the board, depending on the most unanimous one across the board for those that have allocations to bonds. We are going to be recommending inflation protected bonds in your guys' portfolio, mainly because of the fact that we don't believe inflation is going away. If anything, it may tick up. And these products, when unexpected inflation arises, the interest that you receive in return adjusts favorably to increased inflation. So it's a nice way to act as a hedge, because if you have a 3% bond and inflation goes to 4%, your 3% bond ain't going to be worth much, right? Because you're not keeping up with inflation. The last part, and again, this isn't for everyone, but this is really for those that they may already be in retirement, or they don't have these products already. It is going to, and they want to take risk off the table. This may be a great opportunity to consider fixed annuities or an annuity product, because you can get some of the upside risk or the upside returns with annuities, with the understanding that you'll be fully protected from the market. Again, but this isn't for everybody, but it's just for those that are maybe looking to diversify away from the market, but still have some upside, right? But this is really going to be those that are already either in retirement or getting very, very close. That's when annuity makes the most sense. The last option, again, not everyone likes annuities, and I don't blame them, right? It's because they haven't got a good rep. But like we talked about ad nauseum, as long as they solve three problems of either providing long-term care, providing guaranteed income, or a guaranteed death benefit, you can't qualify for the last two. It makes sense, right? So those are going to be the recommendations that we're going to be going across the board, that we're going to be asking you guys to consider. However, to what proportion, how much, should I not, those are all going to be dependent on conversations that you and I have. going into the new year. So the goal of these kind of presentations is, if we see things that we need to pivot away from or pivot to, the goal is to utilize these sessions as a way to bring the information for you guys to digest, give you some time to think about it as well, and then in a way, let's get together, have a conversation about it, because we can't trade without you guys, right? We can't trade without your permission. But if we give you time to digest the information, ask questions, have a conversation with myself, Francisco, and such, we can make adjustments if needed, right? Do we need to, right? If we have a long time horizon, probably not. But we would rather, like I said, be proactive rather than reactive, right? Because I would rather you guys fire me for protecting money and leaving some money on the table than losing money. Right? That's what I would prefer you guys do. I'll sleep better at night knowing I did everything I needed to do to protect your guys' capital. Those are going to be the recommendations. My ask is that you digest this, digest the notes, get on our calendar so that we can at least have conversations to consider this going into the new year, or at least by the first few weeks in February. From what I can see, it should be smooth sailing towards the end of the year. And it should be some pretty calm weathers through January. But as we all know, there's 3 times I'm going to force you to meet with me. And January, February is going to be investments, planning, and then taxes, right? So there'll be opportunities for us to have these discussions. But if these are things that are top of mind or are concerning after this presentation, let's talk about it. But it went a little bit longer than I thought I would. That's okay. I still have 15 minute questions. I would like to kind of open up for questions. I'm going to try and see if I can unmute the mics for those that want to ask a question via the Google, I guess the Google audio. If I'm unsuccessful, please utilize the chat function to ask your questions. Let me see if I can unmute the mics. Bear with me. Where is it? I believe I unmuted everybody.
I'm unable to unmute.
Okay. Actually, Craig, I hear you, which is good.
You pressed the lock, then he pressed unlock on our computer.
And we're unmuted. We're able to switch it off and on now.
Okay.
I did
Excellent.
the same thing.
Excellent. Perfect. So my hope is that by hitting that button, you guys have the choice to unmute, and then we can ask questions as needed. But like I said, this time is for you guys. I'm happy to answer any questions that you guys have. So feel free to ask it over the audio, or feel free to chat it in. Just let me know.
This international stock movement, it seems to me that I can't pick it, but there seems to be an event or several events in the future that are going to drive whether international companies are going to be well off or not so well off with all the politics and all that stuff. When do you agree? And what is that, or what are those milestones we should be looking at?
So the first milestone that we're going to be looking at is how resilient are the corporate earnings actually going to be, right? We've seen an uptick up to this point. So will we continue to see that continued uptick because non-US consumers will continue to spend? So that's going to be a main thing that we'll be continuing to look at. Geopolitical risk is, right, that's Russia decides to attack somebody else, or there's a civil war, God forbid, or something like that. Like, obviously those are concerns, but the way that we approach international investing, right, we're not only investing in one country, we're investing, how do I put it? respectively to their portion of the global stock market. So, for example, Germany will be weighted a lot higher than Zimbabwe, right? Just because of the size of the country and their market, etc. So we feel we diversify away the risk with that by having many different countries instead of like locking in into one. And when we talk about going more international, we're talking about moving slightly some of the allocations to the US into the same proportion of countries that comprise the global stock market. So, like example, if we're going 60% US, 40 when we first started, we're talking about 58% US, 42 international. That 42% of the risk basket would be spread out accordingly to how the non-US market is essentially created. So we're not overweighting specific countries. We are making a decision based on we think the non-US as a whole will do better than the US by tilting that direction. So to answer your question, it's going to be mainly corporate earnings remaining resilient. Another thing that it's not as big as earnings, but it is something that will help. A weak dollar will help, because what it means is when these international companies pay their dividends or earnings in their local currency, right? And if they can return to us as shareholders with more dollars because the US dollar has depreciated, that's a good sign for US investors, right? If it takes less of the opposing money to give us more dollars, that's how we win. So currency will play into it, but primarily it's going to be how resilient are going to be the earnings and spending of non-US spenders. But yeah, great question. What other questions can I answer at this time? I did a really good job, or we just said we're still digesting.
Karmi, thank you. That was a lot of great information.
Yeah, no, my pleasure. I was trying to, when I was putting this together, I was like, there's a lot in here. And my goal was not to overwhelm, but I don't believe I was successful. But I wanted to make sure that you guys are aware of it. We're being proactive, and just giving you guys the choice if we need to pivot, right? We'll give our thoughts, but at the end of the day, it's always your money.
Well, thank you.
My pleasure. If there isn't anything else, I just want to say thank you guys for listening to me. Thank you guys for your trust and partnership. Happy holidays and happy new year. But if I see you guys before then in the office, then I'll just wish you happy holidays and happy new year again. But thank you guys for your trust and partnership.
Thank you.
That was great. Thank you.
Thank you guys.
Bye-bye.
Bye-bye.